Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, Find Value in Underserved Multifamily Markets with Percy Nikora of Penn Capital Group. As a quick note, please be aware that Percy will be answering questions at the end of the presentation. However, feel free to use the Q&A and chat functions on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of that dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you, Percy.
Thanks, Will. I appreciate the opportunity to educate and present this information to Camaplan clients. As you know, Camaplan has been a great partner of ours, and we have many investors who invest with us who are part of Camaplan, and we look forward to that continued partnership. So with that, I'm going to share my screen here. Can the folks on the call see the presentation? All right.
Looks good to me.
Excellent. Thank you. So some of the topics that we hope to cover today, and as Will said, feel free to add questions to the little Q&A section there. I'd much rather have this be interactive, but I know we'll take some questions at the end. But we're going to touch on a little introduction on Penn Capital for those who may not be familiar with us. We'd also touch on multifamily as an asset class. If you're new to multifamily, we'll touch on why our investors and why we like multifamily. We'll also touch on, I guess, why many of you are probably at this webinar, which is to see where can you still find value in multifamily. As many of you might know, values have gone up quite a bit in the last few years. We still believe there are some opportunities that are available in the market, and we'll share some of those with you, or at least our views of those. And then once we identify those opportunities, we'll touch on some best practices that we've seen when it comes to harvesting that value, right? How do we pursue that once we identify the value? We'll dive a little bit into maybe doing some market analysis. We'll share some case studies with you. And then I also threw in some key definitions, especially for those who are new to multifamily. There may be a couple of new terms that you may hear, and I thought that might be beneficial as well. And then, of course, feel free to jump in with any questions you may have. Okay. So obviously, we have to put our own disclaimer here as well. Otherwise, our attorneys would not be happy with us. But in essence, this is saying we're not attorneys, CPAs, or financial advisors, nor do I play one on TV. So as Will said previously, please do consult with your own professionals prior to making any decision. We're not trying to sell you any securities in this presentation. Of course, we are an investment firm, but there are entire separate PPMs, et cetera, that come along with those legal documents. So let's talk about Penn Capital. So Penn Capital is a veteran and minority-owned company. We are owner-operators of multifamily. We are what's called vertically integrated, which is a fancy way of saying that we also manage our own properties, and you'll see why that is important. So as Will said, my name is Percy Nikora. I'm one of the co-founders and a managing partner, along with my partner, Ed Rogan, whose background is in business development and oil and gas. He was also with the U.S. Army with the 82nd Airborne Division and served in Afghanistan. My background is more in large as well as small businesses. I was in Fortune 500 companies like Merrill Lynch, Dow Jones, Pfizer. I also sold a tech company and initially got into real estate to manage my own portfolio. Started to look at scaling it, got into multifamily. Other folks wanted to invest with us. And that's how Penn Capital came about. We also have James Wigan, who's our Chief Financial Officer. He has a real estate background, helping large companies like GE manage their real estate portfolio. And then we have Della Robertson, who heads our property management function. She has 35 plus years of experience in this industry. She's seen it all pretty much when it comes to property management. We have about $175, $180 million of multifamily investments that we've done over the last 6 or 7 years, just under 1,200 doors. And we're about 19 people when it comes to the property management function as well. Some of the projects that we have done has gotten us some regional, let's say, exposure. We were on the front page of the Huntsville Business Journal for a couple of projects that we did, and we'll touch on some case studies as well. So let's jump into the meat of the matter, which is multifamily. And for those of you who may be new to multifamily, or this is a new asset class, why do you hear so much about it, or why do people like to invest in multifamily? Well, number one, you might have heard that there's a shortage of housing, right? And the numbers vary but by many accounts, there's about a 3.8 million housing unit deficit in the US today. Add on top of that, the fact that the prices of the houses continue to appreciate significantly since 2019. And the fact that with the recent interest rate hikes, it's become even more expensive, if you will, to get a mortgage and get into a house. So what that really means is the demand for rental housing has gone up even more than what it was previously. And if you look at the graphic on the right, when it comes to mapping out your risk versus your return, there's a lot of studies that show that, I'll say, commercial real estate or institutional class private real estate is one of the more stable asset classes, which still has relatively good returns. So if you look at the traditional asset classes such as stocks, bonds, etc., yes, they have a decent return, but they also have a certain degree of volatility that comes across with it, right? So when it comes to commercial real estate, it's considered one of the lower volatility classes, but decent returns. And then when you break commercial real estate down even further and you break it into multifamily, office, industrial, and retail, if you look at the graph on the bottom right, this shows that multifamily is still one of the best performing asset classes within commercial real estate. And that green line there is industrial, which is pretty close, at least in the last couple of years. So looking at it another way, one of the reasons why we ourselves like multifamily quite a bit is the volatility, which we touched on, which is relatively low volatility. The fact that it gives you cash flow during the whole period, and we can touch on this a little bit more on some upcoming slides, but essentially when you buy the asset, you're getting rents from the tenants. So during the whole period, as you're making improvements to the property, you do get some cash flow coming in, and that cash flow is distributed to the investors. So that's obviously a nice benefit. The other main difference, I'd say, and people who are new to multifamily may not fully appreciate, is that there's a slight difference in how single-family homes are valued versus multifamily homes. When it comes to single-family homes, those are typically valued based on the surrounding comps. So what's the neighboring property valued at, or maybe what are the properties in a 1 or 2 mile radius valued at, versus multifamily is valued more as a business. And there's a particular formula used to value the property, and that's net operating income divided by the cap rate. And we'll touch on the definition of a cap rate. But in the markets that we operate, the cap rate ranges between 5% and 4%. So if you divide something by 5%, that is a 20x return. So a way to think about it is for every dollar you're adding to the net operating income, or essentially like your EBITDA for business owners, that results in a 20x multiplier in the value of the property. So something as simple as, let's say, a landscaping contract where you may save $1,000 a month in landscaping could result in hundreds of thousands of dollars in savings, or rather that saving could result in hundreds of thousands of dollars in increased value to the property. And that's one of the reasons why we do our own property management, because it's so critical that you keep a close eye on the expenses and that you make every decision based on what is the ultimate value going to be to the increase in the property versus just looking at it from a monthly P&L standpoint. There are also some significant tax benefits. You may have heard the term cost segregation, bonus depreciation, 1031 exchanges. Of course, each of this is a topic in itself, and some of this varies based on whether you're using qualified funds or non-qualified funds. But just be aware that there are some significant tax benefits that come along with real estate as well. And then, of course, you have leverage. So leverage can be a double-edged sword. We like to be prudent in our use of leverage. Most of our properties are not leveraged beyond 65, 70%. And with that sort of leverage, if you go back to what I was mentioning about the net operating income and how it can increase the value of the property, think about it in terms of a business. How many businesses or how many types of businesses do you know where you can use leverage and get a 20x multiplier to every dollar that you're adding to the EBITDA or to the net operating income? And if you know of many, let me know, because I'm always curious and want to invest in more. And then, of course, one of the unique things about multifamily is the term of the leases. And what I mean by that is in commercial real estate, sometimes you may come across a property, let's say a retail shopping center, etc., that may have a long-term lease. And there are some rental increases based into that lease. But what happens if, let's say, interest rates go up, or you need to increase the rents significantly? Well, generally, you're not going to be able to get the benefit of that. Versus in multifamily, you can adapt to changing market conditions because the lease term is typically 12-month lease. So every time you come up for a renewal, you can adjust the lease prices. And then, real estate in general, particularly private real estate, is a good way to create long-term wealth. You sometimes hear the term generational wealth. And if you look at some family offices, real estate makes up a significant part of their portfolio allocation. So now let's dive into our investment thesis, which is finding value in these underserved markets. So what do I mean by an underserved market? Let's identify that a little bit. Let's talk about at least our acquisition criteria and where we've seen value. So to give you a little context, when we first started, we were operating in some of the larger markets. And then what we started to notice in those larger markets was that the cap rates were being compressed, which means that the asset prices were going up. And they were going up fairly significantly. And I think a large reason for that was there was a lot of capital chasing those markets and a lot of institutional capital chasing those markets. And so people started to come to us with some pretty nice offers to purchase these assets. And honestly, after saying, while our business plan was to operate these properties 3 to 5 years, we were getting these offers in year 2, year 3. And when it got to a certain stage, and we were getting our 5-year projections in year, let's say 2.5, year 3, we took that to our investors. We said, hey, these are the opportunities that we have to exit. And we gave them a nice return on their investment. And then we started to look at where else can we find markets where maybe the asset prices are not as inflated, but we still like this asset class, a tangible asset class, particularly multifamily real estate. So we started to look at a lot of different markets. We looked at a lot of proprietary data as well as public data sources. And by looking at the job growth and population growth, we were able to identify some markets that fly below the radar. And an example of that is Huntsville, Alabama. You'll see why in a second. Savannah, Georgia, Wilmington, North Carolina. There's some markets in the panhandle of Florida, for example. These are markets that have some good job growth drivers, population growth drivers, which are the two main reasons or two main foundations upon which multifamily projections can be built. But the asset prices were not as inflated as some of the larger markets. The other factor we were looking at is what is the ratio of someone's income compared to rent that they're paying. What I mean by that, in some of the larger markets, in some areas, about 40% of a person's income was going towards rent. Now that is really high and not really sustainable in our opinion. And while in other markets that had sort of high income jobs, like Huntsville that has aerospace jobs and engineering jobs, but the cost of living is low, only about 20 to 25% of a person's income goes towards rent. So that means that there is a lot more room for rent growth, which is needed when all of a sudden the Fed starts increasing the interest rates, or if you're looking to increase that net operating income. So I hope that made some sense. The other thing we look at are Class A and Class B properties. We believe that Class B properties, which are not overly luxurious properties, but also not what I call workforce housing properties, where you have sort of the more, of these engineer type jobs, people who can work remotely. Those are the areas that we feel are the more stable asset classes at this time. God forbid there's another pandemic, etc. These that class, we believe, is still the more stable class. During COVID, we had a combination of workforce housing as well as this Class A and Class B properties. And what we found is that the rents were a lot more predictable in the Class A and Class B properties, not surprisingly, because unfortunately, the workforce housing, where the tenants tend to be more in retail or hospitality, were the first to get hit. And when it came to these other, Class B and above asset classes, they could still work from home. And in fact, we had some floor plans that had a study or an office in there, and we rebranded that as a 2-bedroom with a Zoom room. And all of a sudden the demand jumped up, and there was like a 4-month waiting list for that type of a floor plan. So, those are the types of asset classes. And there's some other reasons too that I'll touch on in a second. We like to see 1990s and newer build. And as I mentioned before, we try to underwrite it with no more than 65 to 75% loan to value based on the debt that we can get today in the market. And when it comes to our strategy in terms of adding value or improving the NOI for the property, we look at 3 things. One, we look for a value add or opportunistic deal. And what I mean by that is some way in which we can go in, and you may have heard the term forced appreciation. So by making some sort of cosmetic upgrades or some sort of adding some additional either units or adding some amenities, you're able to increase the rents in the asset, get a higher NOI over a few years, and then be able to sell the property at that higher valuation. So that's one approach that we look for, one strategy that we look for. The other is doing a development or redevelopment. So there are some assets that we have bought that have that come along with some land, or in some cases, it's a complete rebuild of the existing asset that you're buying, which allows you to reposition it as something. And that allows you to increase the value as well. And then the third strategy is adaptive reuse. So this is where you buy an asset that may have been used as, let's say, a hotel, and you reposition it as multifamily. Or these days you also hear about office and people buying, especially in urban areas, buying some office buildings and repositioning it as multifamily. So that's called adaptive reuse, and that's a strategy that we look at as well. Now, all of these, we believe, in order to execute on them, you need to have deep relations in the markets that you operate. So we only focus on 3 or 4 key markets. And the reason is we want to have those deep relations, not just with the brokers in those markets, but also with service providers, the local government. And through that network, we can tap into off-market deals. Once you get the asset, you need permission from the government on permits or on certificate of occupancy. You can work with the local government. You got to make sure that they understand that you're there to make an improvement, make an economic impact to the area, and they'll work with you. The other best practice that we see is we believe that it's important to be vertically integrated. Like I said, that doesn't just mean on the property management side, but in a holistic fashion. So we have people looking at acquisitions and disposition and have people responsible for that function. When it comes to capital and debt markets, especially with what's happening in the market these days with the flux in the capital markets, having strong relationships with lenders. So in fact, just in the last year or so, we've been able to close some deals that maybe others may not have been able to, because we had deep relations with those lenders. We've done other deals with them. We focus in those markets, so they know that we are experts in those markets. So we were able to get what's called agency debt, which is a very low cost, or one of the lowest cost debt that you can get in the market, and they typically reserve that for the more experienced sponsors who, again, are known in their markets. And then when it comes to rehab and construction, so we also have a construction manager on site. So this construction manager oversees all the rehab that's happening at the properties. When it comes to, let's say, doing some redevelopment as well, they lead those teams. If we are doing ground up development, then they would oversee that development with the general contractors that we would hire. And then when it comes to property management, we do all of that in-house, from the leasing to the maintenance to the accounting, all of that. And then obviously we also leverage technology. So we believe that it's important to when it comes to real estate, I'll say in general, particularly multifamily, they haven't been the early adopters of technology. So you're starting to see a few areas in which technology can be used as a differentiator. And the way, given our background especially, the way we like to leverage technology, here's an example. So when it comes to market research, we actually paid tens of thousands of dollars for some proprietary data sources. And then we overlay that with some public data as well to constantly look for these markets that I touched on. And we'll see in a little more detail. And then, we also have developed some internal models. So once you identify the market, you come across a deal, we have our own underwriting models that have been refined over the last 6-7 years, and making sure that our projections, are as accurate as they can be. Nobody's going to be 100% accurate right on the dot, but we can try to have our models be as accurate as possible. And then when it comes to revenue optimization, so once you have acquired that asset, you have to operate it, make sure that you're meeting or exceeding the projections. So there are a number of things we do in that area. One is we use artificial intelligence pricing engines when it comes to the lease rents. And previously, this used to be done, I'd say, on a monthly basis. The property manager would set the rent. Some would do it on a quarterly basis, and then just provide that as a rent, sheet to the prospects that come in. These days, the technology allows you to use more of what I like to call a hotel-based pricing engine, where it's dynamically priced. So based on your inventory, as well as the inventory for that floor plan in the area, the software can give you a price based on the supply and demand. And this helps increase the revenue and generate additional revenue as well. So that's one example. Obviously, then there's SEO, social media, different ways of getting your property noticed as opposed to a competitor's property. And then when it comes to our residents, we also like to make sure that they're getting value from this. So we provide high-speed internet. We were one of the first properties in the Huntsville area to offer Google Fiber in our communities. So we provide that at a discounted price to our residents. And at the same time, there's a revenue share that we also get. So it's a win-win situation. And then, we also put some smart home devices as we're doing upgrades to the property. We also have a virtual concierge app. So this is like a smartphone app where people can either have their trash picked up. It used to be called valet trash, but these days there's also a option. Let's say you're running late at work and you want somebody to walk your dog. You can click on a button and have somebody come and walk your dog, or you can have your dry cleaning, taken care of, etc. So I wish sometimes I had that app available to me at home. Some of these features, we don't have ourselves, but we're glad to be able to provide that to our residents. And then when it comes to, just managing the portfolio in general, we can use technology to monitor KPIs across the board, right, across our portfolio. We also look at certain debt covenants. We create dashboards, and we continue to monitor exit opportunities, right? And then when it comes to investor management, there's a portal that we can provide to our investors, streamline communications, provide reports and financial data, automate the distributions via ACH. So technology is starting to be used in all of these areas. And, I think the next few years will be pretty interesting. There's some more AI-based stuff that people are looking into. So it'll be a fascinating few years. So now let's dive into one of the examples of a market that we operate, which is Huntsville, Alabama, and why we chose a market, right? You can take some of the same principles and apply it to other areas as well. This is just an example. So as I mentioned before, one of the key drivers for a good market from a multifamily standpoint is population growth and job growth. And as you can see, we look at this not just over the next 2 or 3 years, but we try to look at it long-term as well. And one of the reasons why we liked Huntsville is because it had some long-term job projections and population growth projections. So as you can see on the bottom here, they're projecting, based on some studies that have been conducted, 38% population growth from 2015 to 2045. 34% household growth, and 18% employment growth. And this is on top of already significant growth that they've seen from 2010 to 2015. So the metrics continue to support that it's going to be a good market. Again, no guarantees, but the projections are heading in the right direction. We also look at the household income. So as you can see, the average household income in that market is over $100,000, which is significantly higher than the national average. And then when it comes to the occupancy and the rent trends, so there's a pretty good increase in the rent growth. And the average market occupancy is actually close to 97% in that market, which is pretty significant. National average for multifamily is around 92, 93%. So there was already high demand, and then you couple that with the projected job growth, population growth, that's going to increase that even more. Yes, you have to overlay that with the supply that's coming in the market, and there is a little bit of supply, but the demand still outgrows the supply. And then we look at sort of the, just continue to look at the employment. You can see there's a steady rise in the employment, one exception being during COVID. But one of the things we also look at is how fast did it recover after COVID. So it obviously took a hit like most areas do, but then it bounced back really quick, which is, again, another positive sign. We also look at employers. So these are some of the key employers, and we look at diversity across that employer base. So there are government jobs there. There's a lot of aerospace. Mazda and Toyota opened a $2.3 billion manufacturing plant. There are two, I think, Amazon distribution centers. NASA is based there. Blue Origin, which is Jeff Bezos' space program, is based there. The largest data center that Meta or Facebook has is based there. So as you can see, it has a diverse set of, it also has some healthcare jobs there. So there's a diverse set of employers there. And as you saw in the previous slides, the demand continues to rise. So let's say you've identified the market, and then you come across, you start looking at deals in that market. How do you know it's a good deal, or what are some potential ways to identify some value in those multifamily opportunities that you might find? So here are some case studies. Again, there may be, obviously, one good thing about real estate is it's so broad. There's so many different ways to derive value from it that we're just scratching the surface. But here are some examples of what we've found in the past, and hopefully this will provide some insight into what you may be able to find or look for as well. So the first one is a Class A institutional asset. So this is a 232-unit property that we currently own. This is what I would call a cash flowing asset. It's an institutional class asset. As you can see, we have Walker Dunlop as an institutional equity partner on this. So these are the types of assets that large institutional investors like to co-invest, with us on. And it's, again, like I said, it's cash flowing, and they see it as a nice, safe place to place their money. Now, what we are able to do is go and make some small cosmetic improvements. And by doing that, we are able to increase the revenue or the rents over time. And as you can see here, in 12 months, we increased the revenue by over $50,000 a month. And that led to an increase in the NOI. And just, we actually had an offer on this property by increasing the NOI for $15 million more than what we paid on the property. So what may not seem like huge improvements, because the renovations that we made were like $1.5 million, $2 million, which is not a lot compared to the return that you're able to get on the property, right? So we purchased it just under 40 million, put in a couple million, and within 2 years, the offer we got was for 15 million more than what we paid for that. Another example is sort of the opposite end of the spectrum, is instead of a Class A property, look at a Class C property, which is a heavy value add. Now here, this was a 1960s asset, 390 units right across the University of Alabama at Huntsville. Great location, but it really needed a lot of work. So we were able to go in, put in a lot of money into the renovations, reposition the tenant base, and we bought it at 12.5 million, and in 2.5 years we sold it at a little over 30 million. Now, it's a little harder to find these types of opportunities, and as I mentioned before, since COVID, we're not doing those types of projects anymore. We're moving more towards the Class A and Class B properties. But if we come across a really good opportunity like this, we definitely jump on it again. Another case study that touches on a strategy that I'd mentioned previously around adaptive reuse. So this is a hotel. This was a abandoned hotel that we actually bought next to one of the other property that I just had up. And we came across this, pretty much paid through, bought it off market, paid the a very nominal amount for it, and then in about 2.5 years, completely redid the project inside outside, and we repositioned it as corporate housing, and we were able to give a nice little return to our investors. So this property, we redid this, and while we were even leasing it up, our plan was to completely lease it up and then maybe sell it. But as we hit 50%, we started getting offers. And then I think by the time we sold it, we were like 70%, and we were able to sell that. And then our most recent acquisition, this is let's say an up and coming asset class, sometimes called build for rent or build to rent. And this is one where it's an existing asset. It's a 98 units. It's more of a single story type house floor plan. It's more like a house of families like that, as opposed to being, having units above you. So this is in high demand. This particular project also came with 10 acres of land where we could build an additional 120 units. So this is an example of one of those, projects that has existing cash flow asset, and then you have an opportunity to do some additional development as well. So we haven't necessarily said we're going to do the development, but we have the option of doing that as a second phase. So those are the kind of projects that we like to find that have multiple exit opportunities and multiple ways to add additional returns to our investors. So hopefully, this gives you a little bit of an idea of the different types of opportunities that exist in multifamily. Here are just some pictures of that asset that we bought. It was almost a new construction. It was December 21 that it was completed. They leased it up in 22, and we bought it straight from the builder. Because of our contacts in that market, and because we were fairly well known in the market, we were able to buy it at a 20% discount. And again, hopefully, be able to give a good return to our investors. So with that, let me come to a few key terms, especially if you're new to multifamily and you're starting to look at it. You may hear some of these terms, or different sponsors might use different terms. So wanted to spend maybe just a minute or so on this. So you may hear of AAR, or average annual return. And this is very simply put, what is the return at the end of the investment period where you're looking back? So let's say it's a 5-year investment. You put in 100,000. At the end of 5 years, through everything from day one through the last day, you've made 200,000, including that initial 100,000. So your net return was that 100,000, right? So let's say divide that by 5, that would be 20%. So your average annual return would be 20%, a simple way of looking at it. Another metric sometimes people use is internal rate of return. Now, the IRR might be a little different based on when the cash was distributed to the investor. So this gets a little more complicated. Just keep in mind, it takes into account the time value of money. So there are some formulas that are used for it, but in essence, it's a way to say, if I'm putting out 100,000, how much of it am I getting upfront versus later on? And if it is more weighted towards the back end, then your IRR will be slightly lower. Equity multiple, again, this is a term used to say, if you make the initial investment, at the end of it, what are you getting back, and what is the multiplier on it? So if you put in 100,000, at the end of it, you're getting 200. That's a 2x equity multiple, including that initial 100K that you put in. And then I'm not going to touch on all of these, but one thing I do want to mention is preferred return, because I do sometimes see relatively new investors get a little confused by this phrase or maybe don't fully understand it. So preferred return is really the amount that gets paid before another class or the sponsor would partake in their portion. So it does not mean, so let's say if a particular deal has a 7% or 8% preferred return, it doesn't mean that you're going to get that every year. Especially in multifamily, or I'll just talk about our deals. We tell our investors, look, you can expect a 4 to 6% cash on cash return on the first 2 years, and then as we make improvements to the property, we provide more amenities to our clients. Improvements, we start increasing the rents, and that's when the cash flow goes up. Sometimes we do a refinance starting in year 3, or we start looking at selling the property. So typically speaking, there's a little bit of cash flow in the first couple of years. Then we start looking at either selling the property or doing a refinance on the property. So in years 3 onwards is generally when you see majority of the capital coming back or return on the investment, at least on the projects we do. Every sponsor is going to be slightly different, but that's something I would be cognizant of and make sure you understand the investment that you're going into and the cash flow distribution for that investment. Okay. And then, so how do you get started? What are the documents that you should be looking at? I'm sure Comma Plan will guide you through it, but some of the key documents you should be looking at is the private placement memorandum. Our lawyer likes to say that this is the document that is meant to highlight all the risks and scare the investor away from making the investment. So this has all the disclosures. So make sure you go through that. The operating agreement, since most of these investments, or at least our investments, are done through an LLC, and when you make the investment, you're joining as a member of that LLC, you want to understand the operating agreement which governs that LLC. So that'll have the cash flow distributions, and just lays out how that LLC is going to be operated. And for the most part, the sponsor is the managing member of that LLC and has certain rights. So understand what your rights are, what the responsibilities are for the sponsor, etc. And then a subscription agreement. This is what a document saying, okay, this is where you're going to apply or subscribe to be part of that syndication or that fund and that LLC. And it's up to the sponsor then to review that in conjunction with the next document, which is the investor questionnaire. Make sure that they have all the information needed. It has your personal information. Maybe if you're investing through your qualified plan, it has your plan's information. They make sure it's a good fit, especially if it's a investment only for accredited investors, making sure that you're accredited and that you meet all the qualifications. And then the sponsor would sort of sign off and make you a member of that LLC. So these are just some of the key documents and the terms that you may hear as well. Okay. So with that, I know I went on for quite a bit, so I'm going to pause here. Here's my contact information. Feel free to reach out to me, on any topic related to multifamily. But with that, maybe Will can open it up for questions, Will, and see. I see a couple of questions that might be.
Absolutely.
Coming in.
Absolutely. Thank you, Percy, for the presentation and all the insights you gave us today. Please leave your contact information up while we go over these questions, if that's okay. So we have a good amount of questions coming in. Please, if you haven't put your question in now, use the Q&A function in the chat and do it, and we'll try to address as many as we can. First question is a pretty quick one from Dinesh. He says, great presentation. Would we be able to get a copy of this deck? I know for sure we're sending out a link to the recording to everybody who registered for the event, but Percy, would you be able to provide the slide deck to people interested?
Yeah, sure. Absolutely.
Great. Thank you for that. I would suggest shooting an email over to Percy, and I'm sure he'll be happy to help. This next one comes in from Michael. It's a 3-parter, so I'll read it all at once, but feel free to break it down. Do the increased interest rates help or hurt new purchase prices? Do you find banks are tightening credit on multifamily properties? And past projects have been good in the inflationary environment. Does the new economy present any additional risks or challenges?
Yep, good questions. I'll try to answer them in the order. So do the increased interest rates help or hurt new purchases? Okay, good question. So I'd say a little bit of both, and I'll explain what I mean by that. Obviously, when it comes to sourcing your capital, it has been a little more challenging, right? So previously, lenders, which if you think about a capital stack, when we purchase a property, it's anywhere between 25 to 50 million. About a large percentage of that is provided by the lender, right? That's called the senior debt. And typically that, obviously in a few years ago, we have properties that we secured with 3.35% debt. We're not going to see that anytime soon. Nowadays, it's more like, I think the one we just closed was 5.6%. But more importantly, the loan to value that you're able to get has also gone down, right? Part of the multiple reasons for that. But because of that, so previously you used to be able to get maybe, let's say 75%, maybe even 80% loan to value on just from the senior lender. And now you're getting anywhere between 55 to 65%. So what that means is you need to fill that gap by the other other sort of sources in your capital stack. And those tend to be more expensive because you're looking at either what's called preferred debt or mezz financing sometimes, or LP equity. And that becomes more expensive and therefore hurts the return of the project overall. So that's the part that is a little more of a headwind these days, right? Or you have to raise more capital. Now, the silver lining is that we do see some opportunities and also come on the horizon because of what's happening in the capital markets. So what we're seeing is that just in the last few months, a few deals have come to us off market, but the sellers are saying, hey, can you close on this opportunity in 45 days or 60 days? And the challenge there is in doing it in a typical syndication model has been a bit challenging. And that's one of the reasons why we started a fund. So we have a $50 million fund that has some, we want to have some dry powder in there so that when we see these opportunities, we can then commit to them, tie them up and get a good deal for our investors and for everyone. So that's, so that's the yes and no to the first part of your question. The second one is, do you find banks are tightening credit on multifamily properties? Yes. So they're being a lot more selective on who they are giving the deals to. It's taking a little longer to underwrite. Obviously, anytime there's uncertainty, they're going to be a little more cautious, right? So that's what they're doing, and that's fine with us. We're still getting through. We have a good track record. It just takes a little bit longer, and like I said before, the LTVs are a little lower than what it was before. And then past projects have been good in inflationary environment. Does the new economy present any additional risk and challenges? Yeah, I think so. So yes, previously there have been some tailwinds, but to us, that's why we believe it's really important to identify the right markets in which you can operate, and the right markets can position you well for these economic times. And what I mean by that is going back to the example I used, where the markets we operate under, or we operate in rather, people use their only about 20 to 25% of their income is going towards rent. So if we operate in those types of markets, we think that's positioning us better than markets where maybe somebody's paying 40% of their income going towards rent, right? So by identifying the right markets that still have some room for rent growth, and where we're still seeing relatively strong rent growth of 10 to 12%, even though we underwrite for 3 to 4% rent growths, we're also being conservative on our side in these uncertain times, and being a little more diligent when we stress test our own assumptions as well. Again, no guarantees; these are still projections, but the banks are being a little more cautious, and we only pursue opportunities that we are pretty confident in. So hopefully that addresses those questions, Michael.
Very, very well put, Percy. Thank you for that. We do have a lot of questions to get through, so we'll try to get it again. We'll try to get as many as we can in. For somebody who is new to multifamily, how would you recommend getting started?
So obviously, I would say do your due diligence, especially get to know the sponsor a little bit, understand what their strategy is, understand which markets they operate in, make sure it aligns with what you're looking for, make sure the type of projects they have meets your investment criteria. And then I would reach out to your comma plan advisor and make sure that you're set up correctly, because I know some folks are can qualify for a solo 401k. Some qualify for either a Roth, self-directed Roth or self-directed IRA. Make sure you have the right vehicle, because there are some pros and cons of using one versus the other. And I'm sure your comma plan representative can fill you in on those details.
Absolutely. We're more than happy to help anybody who has questions about, getting their retirement funds into alternative investments like these. Next question. Do you use a UBIT or UDFI blocker strategy for IRAs when you have debt in a deal?
So we do not. I know there are some, I've seen them used in some large funds through some offshore blockers, etc. But you start getting into some complex structures and overseas entities, etc. So we have not used them. Plus, I don't think it's as bad as you think it is when you actually run the calculation. There isn't a lot of UBIT from the type of projects that we do. But again, this is where I would ask you to consult your CPA as well and see how that impacts your personal situation. But we do not use UBIT blockers.
Great, thank you. And for additional clarification for people who may not know what UBIT or UDFI are, UBIT is unrelated business income tax, and UDFI is unrelated debt financed income. They're not very common, but you do run across them sometimes while using an IRA. Like you said, people that run into them, I've heard, are usually okay with it because they'd be paying taxes outside of the IRA anyway, and they're still using it to grow their retirement funds quicker than they may be with another investment that they may be working with. So thank you for that clarification, but always talk to your CPA, of course, when it comes to that. Next question we have is, what is the distribution frequency for investments like these? And are the distributions the same throughout, or do they vary?
Yeah, good question. So again, this can vary a little bit by project, but for our projects, we try to keep them at a quarterly distribution. We have done projects in the past where it was a monthly distribution. And what we were finding is that just the admin overhead is a bit much for the amount of distribution that you're getting, which ultimately, is going to impact the returns for the investors. So I think quarterly is a good balance. So we make quarterly cash flow distributions automatically through an ACH. So the money just shows up in your account or comma plans account, and then they forward it to your plans account. And the way that distribution typically works, I wish I had a cash flow slide, but in general, again, it will vary a little bit by project, but we tell our investors expect, like a 4 to 6% distribution in the first 2 years. After that, it can start going up a little bit. But, by the time we get to year 3 for our projects, we've been fortunate enough that we've actually exited most of our projects by year 3. I think our longest hold period has been 3.5 years. But in knowing that we're going into a different market cycle, we still feel confident with the 3 to 5 years in the markets that we operate. But what we're telling our investors is expect to hold it longer. We may just have to sell it closer to year 5, or we may do a refinance between years 3 and year 5. So that's when you would see majority of that return off capital or return on your capital, depending on whether it's a sale or refinance.
Great. Thank you for the clarification, Percy. We have two questions coming in that are I would say more directed towards IRAs, but and I'll try to answer them. Feel free to add anything to the end of them as well, Percy, if you'd like.
Sure.
So one question coming in, can I use an old IRA or 401k account? Can I invest combination of retirement and non-retirement funds? So for the first part, if you can use old 401ks and IRAs, if you're not currently employed by a plan that offered you the 401k, I'd like to clarify, I could talk all day about this. I'd like to clarify that every plan's a little bit different. So always talk to your plan administrator on their specific plan's rules for rolling over outside of the plan. I know that when you're currently employed by the company, the only ways usually are via in-service rollover or by opening an outsourced account for that plan. Both things that we offer and we can help facilitate and answer questions about. Again, check with your plan administrator. If you're no longer employed by the company, then you're more likely than not able to move that out. Now, again, check with your plan administrator because some companies do have a period after your employment is terminated where you're still not allowed to roll over the funds. So you definitely want to check with them first. IRAs, they're your accounts. They're not linked to any employers except if they're SEP or simple IRAs, but you're always able to move them. With the exception of the simple IRA, you do have to have that account open for at least 2 years before you're moving it. Any funds, moving that account anywhere else. Now, you can partner your IRAs and your employer plans, your qualified funds with different entities. You can combine them, partner them with a deal. Even there are some prohibited transactions coming when it comes to IRAs, but and some disqualified persons, but that doesn't prohibit you from actually partnering with those entities. And Percy, if you have anything, from your end as a fundraiser when it comes to partnering entities, please add that.
Yeah. So, again, so first off, thanks for answering the first question because you're much more qualified to answer that in more detail. But when it comes to investing, let's say using your qualified and non-qualified funds, again, making sure that as long as it's not a prohibited transaction, I'll talk for Penn Capital because this is a little sponsor dependent. We are looking for long-term relationships. So if a new investor comes to us and says, "Hey, look, I'd like to use some of my let's say non-retirement funds, but then I also have a certain amount sitting in the qualified funds or retirement self-directed funds, and I'd like to use that as well. Is that possible?" And we've said sure, that's fine. So we'll work with you as long we're looking at it holistically in terms of an overall relationship, and we want to build a long-term relationship. So like I said, making sure you meet all the rules, and it's not a prohibited transaction. It doesn't matter which bucket you're using the funds from to us.
Of course, great. That's great that you guys have that flexibility and are willing to work with people. Another one, this is kind of more directed towards IRA, so I'll answer it. But again, feel free to tag in. Can I use depreciation if I use a qualified account? Now, the answer is no, because the IRA is already a tax sheltered account. So you're already reaping those tax benefits of not paying any taxes while the funds are within the IRA. And then if it's a tax deferred account like a traditional IRA, you'll have to pay those taxes on the contributions and earnings when you take that out at distribution. But if you're in a Roth IRA, which is why I'm kind of partial to the Roth IRAs to begin with, you pay your taxes on the contributions, and then everything afterwards, once you reach an eligible age to take qualified distributions, which is 59 and a half or older, everything after that is tax-free, which is amazing.
You answered it perfectly, so nothing to add there.
Thank you, Percy. And the last question we have at the moment, and it looks like perfect timing because we're coming to the cutoff point, is what are the typical minimum investment amounts you see, Percy?
Yeah, so every sponsor I think is gonna be slightly different, and it also I think depends on the type of offering. These days that you see a Reg A, Reg A Plus, etc. For our offerings, our minimums in the documents you might see 100,000. But like I said, we're looking for long-term relations with our investors. So we've taken anything 50,000, or in some cases maybe even a little below that. You know, there is a certain point where there's some administrative overhead that goes into setting up these things. But around 50,000 is what we would keep as a minimum.
Great, thank you, Percy. And before we wrap up, I do want to clarify on some of my previous answers. I mentioned specifically when you're partnering with different entities and using old accounts, self-directed is just an adjective. All of our accounts at Camaplan are self-directed. So traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, HSAs, ESAs, even solo 401ks, we do it all, and all of them with us are self-directed. So simple IRAs for one could definitely be moved into Camaplan and self-directed. There's just that 2-year waiting period that I mentioned earlier. And when it comes to the depreciation, if there is, I want to clarify, there is a possibility of using depreciation. If there is UDFI, you can take a percentage of depreciation with the IRA. So I wanted to clarify that before we wrap up. And Percy, I want to thank you for lending your time to us, providing us with all the information you did today. Now, before we wrap up, is there any closing thoughts or any ways that you want people to get in touch with you before we end off?
No, I just want to thank people for their time, and again, thank Camaplan for being a great partner. And you know, if people want this presentation or have any questions in general, here's my contact information. Feel free to reach out.
Thank you, Percy. And again, on behalf of Camaplan, I want to thank you and everybody who attended today's webinar for their time. And everybody will be receiving a copy of this recording, and I hope you all have a great rest of your day.
Thank you.